Hello friends, in this video, we will look at Accounting Standard 12, Government Grants in greater detail. Now, what are government grants? So basically this standard deals with the accounting of government grants. Government grants, they are sometimes called by other names as well, like subsidies, cash incentives, duty drawbacks, etc. They are some kind of assistance which the government is giving in cash or in kind to an enterprise for past or the future compliance with some conditions. So the most important point is whenever you get a grant from a government, it could be free, but there are a lot of conditions to be fulfilled, right? Now, what is not included in the government grants? That is important. The forms of government assistance which cannot reasonably have a value placed on them. That is one. And transactions with government which cannot be distinguished from the normal trading transactions of the enterprise. So if you are actually, let's take dealing with the third party, and if you have the same terms and conditions with the government also, then we can say that there is no kind of a government assistance there, right? So there is no government grant, especially when the terms and conditions are the same, both for private party, third parties, as well as for the government, right? There is no question of government grant there. The most important thing is, what is the recognition criteria? Government grants should not be recognized until there is a reasonable assurance, not the word, a reasonable assurance that the enterprise will comply with the conditions attached to them and the grant will be received. Two conditions are cumulative. You should have a reasonable assurance that the enterprise will comply with the conditions attached to them. I always told you that whenever you get a grant, you need to comply with some conditions as well. So if you are not sure that whether we will be in a position to comply with those conditions, then you can't recognize the government grant. So two things are important. You should have a reasonable assurance that the enterprise will comply with the conditions which are attached to the government grants, and then the grant should be received. You should have some assurance that the government will give you the grant. So if these two conditions are satisfied, then you can recognize the government grant. Okay. Now, we will deal with the accounting treatment for the government grants. So government grants can be for a lot of things. It can be for non-monetary assets. It can be for, or it can be a monetary grant. It can be for a depreciable asset. It can be for a non-depreciable asset. It can be for an item of revenue, or it can be for a kind of a promoter's contribution. So we will deal with each of these areas separately. And if you see the tabular column, I've said nature of the grant, treatment of the receipt of the government grant, and treatment if the grant becomes refundable. So let's discuss the refund also simultaneously. Now, non-monetary assets given free of cost. Suppose if the government gives you, let's take a land free of cost, then we need to record it at a nominal value. We can't just ignore saying that I have not spent any money on that asset, it's free. So you can't do that. We need to record it at a nominal value. What happens if the grant becomes refundable? There is no accounting treatment there, which is prescribed by the standard. Now let's talk about some monetary grants. Grants which are given for depreciable fixed assets. So when you receive a grant from the government in respect of a depreciable fixed asset, let's take a building, right? Let's take a plant and machinery, something like that. Then you've got two options. Number one, option one is to show the grant as a deduction from the gross value of the asset and depreciation to be provided on the net value. So whenever you buy the asset, you pass the entry fixed asset to bank. And when you receive the grant in relation to a fixed asset, we pass the entry bank account debit to fixed asset. We give a credit to the fixed asset account, bank account debit to fixed asset. That is option one. And the depreciation should be provided only on the net value. This is very important, right? Now they say where the grant equals the whole or virtually the whole of the cost of the asset, you should show the asset at a nominal value. Let's take if the plant and machinery is 10 lakhs and if the grant value is like 9,50,000, it's almost equals the whole value of the asset. Then we need to show the asset at its nominal value. This is the first option. Now, what happens if the grant becomes refundable? First, we need to understand why it becomes refundable, because we may not have fulfilled some of the conditions. So the grant may become refundable. If that be the case, if we are following option number 1, then we need to add the value of the grant which is refunded to the book value of the asset. So in other words, the book value of the asset is to be increased by the amount refundable to the government. And then depreciation is to be provided on the revised book value prospectively over the remaining useful life. So we need to, so whatever was the book value, right, before the refund of the grant, you have that, you take that, and then you need to increase that book value by the amount of the government grant which is getting refunded. And then, so what will happen? The book value will go up. So that's a revised book value. So we need to provide depreciation on the revised book value prospectively over the remaining useful life. These words are important. Prospectively over the remaining useful life. So don't worry, we will be doing a lot of problems on this. As and when we solve the problem, we will be revisiting this standard. What is the option number 2? Especially when the grant is which is relating to a depreciable fixed asset. The second option is, instead of giving a credit to the fixed asset account, we can actually take it as a deferred income, and then we can recognize in the statement of P&L on a systematic and rational basis over the useful life of the asset. That is important, because this is a grant which is relating to a fixed asset, right? So we need to consider the useful life of the asset. So what we can do, instead of taking as a credit to the fixed asset account, we can actually take it as a deferred income, right? And we need to recognize it in the statement of P&L on a systematic and rational basis over the useful life of the asset. Let's take, for example, the grant is 16 lakhs. The grant is 16 lakhs and the useful life is 4 years. So every year we can actually amortize 4 lakhs. We can actually consider, or we can say recognize 4 lakhs as an income in the statement of P&L. This is what it is. It's actually getting addressed actually. Okay. Now, what happens in this case? If this grant becomes refundable, then you have to do the opposite. The amount refundable to be reduced from the unamortized deferred income balance, and excess amount to be charged to statement of P&L. Let me give an example. I took this 16 lakhs example, right? So when you receive 16 lakhs as income, as a government grant, and we are pressing option number 2, which is we are taking it as a deferred income. If that be the case, let's take useful life is 4 years. So 16 lakhs by 4 is 4 lakhs every year. So 2 years things were fine. So which means 8 lakhs would have gone to the P&L account. From the deferred credit, we would have transferred to the statement of P&L. So the balance remaining in the deferred credit is another 8 lakhs. Now that the grant becomes refundable, and assuming you are going to refund the entire 16 lakhs, right? 16 lakhs. So we need to debit the deferred income credit as 8 lakhs, and whatever balance we are actually taken to the P&L account as a credit, we need to reverse that. So it's going to be deferred government grant is 8 lakhs, P&L 8 lakhs to bank is 16 lakhs. This is the entry. Okay. Now, what about grants which are relating to a non-depreciable asset? Now, when the grant does not require fulfillment of certain obligations, this is rare, but sometimes it does happen. So when you get a grant which is relating to a non-depreciable asset, and when there are no strings attached, no obligations attached, then you can take it as a capital reserve, because it's like a capital profit. And what happens if you don't comply with certain obligations, right? For some reason, if that grant becomes refundable, even though we say that it does not require fulfillment of certain obligations, by and large it will be taken to the capital reserve. But in an odd situation, when that grant becomes refundable, then we need to actually reduce it from the capital reserve, which means we have to debit capital reserve. Okay. Now, when the grant requires fulfillment of certain obligations, it is credited to income over the same period over which the cost of meeting such obligation is charged to income. Okay. So when the grant is given for a non-depreciable asset, and when the grant requires fulfillment of certain obligations, then we need to credit that to income over the same period over which the cost of meeting such obligation is charged to income. So when we say when there are certain strings attached, with certain obligations which we need to comply, so there is going to be a cost for meeting such obligation, right? So let's take if that obligation is going to be 5 years, then we will recognize the grant as an income over a 5-year period. But if there are no strings attached, then like this one, we can actually take it to capital reserve. But if it requires the fulfillment of certain obligations, then we need to find out the period over which we will be meeting such obligations, and it's better we recognize the grant as an income over that period. Now, what happens if that grant becomes refundable? Same principle. The amount refundable to be reduced from the unamortized deferred income balance, and excess, if any, will be charged to the P&L account. Similar treatment only. Okay. What happens in the case of a grant which relates to revenue? So we talked about a non-depreciable asset, depreciable asset. What happens if the grant is relating to revenue? Now, generally it is recognized on a systematic basis in the statement of P&L over the periods necessary to match the grant with the related costs they are intended to compensate. Because this is a grant which relates to revenue. Let's take an employee benefit or employee welfare expense. So obviously there will be a time period over which you will be incurring the employee welfare expenses. And if the government is going to give you a grant to meet those employee welfare expenses or employee benefit expenses, let's take it's a 7-year period. Then obviously you need to recognize the grant over the 7-year period. Okay, so it is recognized on a systematic basis in the statement of P&L over the periods necessary to match the grant with the related cost they are intended to compensate. So the cost is what? Employee welfare expenses. So if you feel that you will be incurring the employee welfare expenses over a 7-year period for which this grant was received, then probably you should recognize the grant in the P&L account on a 7-year basis over the 7 years. What happens? And then, okay, but sir, how do we show the presentation? There are two options of presenting it. Simple, you can show it under other income in the P&L account, or option number 2, we can show it as a deduction in reporting the employee or whatever expense it is. So when you have an expense, you can show this grant as a deduction. So there are two options which are prescribed by the standard. Okay. Now what happens if that grant becomes refundable? So the unamortized deferred credit of the grant is first utilized and excess amount to be charged to statement of P&L. Okay, that's important because we are going to recognize over a 7-year period. So obviously some amount will be, let's take year 1, year 2, year 3, everything goes fine. So you will have an amount which is remaining in the deferred credit account. So when the grant becomes refundable, you need to actually refund. You need to actually pass the entry for the refund also. So you will debit the deferred credit balance first, and then excess, if any, will be charged to the statement of P&L. Sometimes you will have a grant which is in the nature of a promoter's contribution, which means the government readily wants to bear one part of the total investment. If the investment is 100 crores, government says I'll bear 20 crores out of that. So they are given with reference to the total investment in the undertaking, or by way of a contribution towards its total capital outlay, and no repayment is ordinarily expected in the case of such grants. So of course there are some conditions, but generally the government wants to sponsor you. So there is no repayment which is expected by the government. If that is the case, you need to take it to capital reserve, right? But if the purpose for which the grant was given, if that is not accomplished, then probably you may have to refund the government grant, in which case any amount refunded should be reduced from the capital reserve. Okay. Now, sometimes you may receive a government grant as a compensation for expenses or losses incurred in a previous accounting period, or for the purpose of giving an immediate financial support to the enterprise with no further related costs. So if you have a situation like this, like for I've been incurring a lot of expenses, lot of losses, and the government wants to sponsor me or wants to fund me, then to be recognized and disclosed in the statement of P&L as an extraordinary item. That's important because you are not going to get this kind of government support year on year. So one time. So please consider, please recognize it and disclose in the statement of P&L for the period which they are receivable as an extraordinary item in lines with AS 5. And finally, what are the disclosure requirements? The accounting policy which is adopted for the government grants, including the method of presentation in the financial statements, that we need to disclose, option 1, option 2. Right? So are we going to show it as a deduction from the fixed assets, or are we going to take it as deferred income? That is important. Then the nature and extent of the government grant recognized in the financial statements, including the grants of the non-monetary assets given at a concessional rate. All those things we need to actually disclose. Okay. So this is by far the accounting standard explanation for AS 12. And don't worry, we will back it up with a lot of problems, and time and again we will be revisiting the standard again. Thank you.